Hello, hello. Welcome to episode 40 of the Golden Question podcast. In today's episode, we are answering the question what the 40% capital gains rate means for the economy. So, I haven't made a video in a while, or at least a podcast in a while. I do in the future hopefully plan on getting a studio where I'll set a camera down and we'll have a actual live video feed going along with the podcast. But for now, we're just keeping it straight audio, something you could listen to on your car ride, on your bike ride, or even for a walk or a jog, or something you put on in the background while you may work on something. I haven't made a video in about a year. Last time was I believe the last video was uploaded in August. So I've been real busy working, getting into the field of taxation and having many clients to work on. Thankfully, and being blessed on working on my first ever estate tax client, which now that it's on its conclusion phase, just on the preparation. Of course, the audit will still ensue and then that'll reignite the work. But after working on this estate tax client, it really highlights what I want to do. And it really showed me, okay, this is something that I want to do going forward. So just, I guess, I can make some updates on my professional career, where it's going, what I'm learning, and something that may benefit you guys. But in today's video, we are going to be talking about the 40% capital gains rate that Biden is proposing. So something that I guess for some people that doesn't make sense is, why does earned income, people actually out in the field working, getting a wage, why is their income, of course, not only subject to withholding tax, but also subject to just a higher tax as opposed to taxation, a tax that's imposed on someone's capital gains, right? Someone buying an asset and then flipping it. That's, from the tax perspective, is considered unearned income. And ostensibly, it gets a preferential treatment. Why is that? Shouldn't income that is earned be taxed at a lower rate than income that is unearned? And so this is something, on face value, that I think didn't make sense to me. However, the argument, of course, is that the government wants to incentivize investments. And so, of course, with investments, you have capital appreciation, which is why someone would want to get into an investment. And so this idea that if you encourage investments by lowering the tax rate on any appreciation from those investments, you essentially incentivize those investments. But to me, it still doesn't make sense. Someone who sits on an asset, especially in today's world of inflation and easy money policy, it's not hard to just sit on an asset and have it inflate in value. Of course, part of that inflation is probably not real. It's just what's on paper, right? You have your stock or whatever appreciating, and especially if you hold a lot of it, if you actually do try to go and sell it, you may realize, wait a second, there's not enough buyers, and just by you putting in the sell orders, you can cause the price to collapse, right? Again, this is just on a larger scale here, and which highlights the idea that all those gains are just on paper. Actually trying to go and sell that stuff will cause the prices to go down, but also a factor of that appreciation is purely inflationary. It's purely the Fed pumping money in, of course, generating artificial demand. And so, yeah, your property that you've been holding for 10 years appreciated whatever amount it did, but the dollars that you get from the proceeds of the sale actually end up buying the same that you would have got prior to buying the asset. And so really, you just sort of prevented inflation from wiping away your assets, but sometimes it doesn't even cover inflation. Again, we don't rely on the government numbers. So, the appreciation in the asset probably doesn't even cover the inflation that occurred over those years. And so you're still, in real terms, worse off. So you have those two things. And so the idea is, people who think that they are benefiting from the economy by holding these appreciated assets and benefiting from the Fed's inflationary policies, I think Biden is doing the right thing in that they should be taxed at a higher rate versus someone who's out there in the field actually generating income, as opposed to someone who's just sitting on an asset, telling the Fed, yeah, keep printing money, it's going to help my assets appreciate. Of course, little does he know that the appreciation is not real. Of course, it's just inflation that's pushing everything up. But the idea is, in the meantime, while this party's still going, yeah, his assets are appreciating. He can take debt on those assets, and that's a big thing, right? A lot of them, instead of liquidating, they just use them as a security on a loan or collateral on a loan, and then they get the real money without actually having to sell into the market and triggering, this correction. But to me, this sentiment, I think, will come back and it will get questioned. Why are we giving this preferential rate to capital gains? Who recognizes a lot of these capital gains? It's the wealthier people. And of course, the wealthy people have the most to benefit from inflation, especially because they are heavily indebted. I mean, in real terms, they're more in debt than the middle class and the working class. And so by having inflationary policy and easy money policy, it not only does it sort of help appreciate their assets, again, even though it's not real, but it also helps wipe away their debt. I mean, this is another consequence, and it's also affecting the United States government itself with the amount of debt that it has. And I think I looked at a metric that Peter Schiff pointed out. He was on the Patrick podcast, Patrick Bet-David. I think I'm saying his name correctly. He pointed out the fact that soon the interest expense is going to surpass what we spend on. I think it has already surpassed what we spend on military, on the defense. And so right now, the only thing that that it's going to surpass is Social Security and Medicare. Once it surpasses that, the highest interest, the highest expense item on the United States balance sheet is the interest on its debt. And not only that, if you compare the amount that we're paying in interest to the amount we're collecting in revenue, it's almost dollar for dollar, which is kind of scary to think that all the taxes that we're paying isn't going to fund all these programs. It's going to pay off the interest on our creditors. So basically, the way that Peter Schiff looked at it is the United States government is essentially just this conduit of collecting taxes from people and paying off their creditors. And that is a very scary thought. But back to the capital gains. If we're not going to reduce spending, you have to raise taxes. And this is what I don't get about Republicans and why I sort of sympathize with the Democrats is that, they want all these government programs, but at least they're being honest and saying, hey, we're going to have to raise your taxes. We're going to have to pay for this. The Republicans, on the other hand, say, no, we're going to keep all your entitlements. We're going to keep the government spending, and we're going to lower your taxes. And so how does one pay for all this? How does the government pay for all this? It goes deeper into debt, which is in the long term worse off for the economy. Going into debt to pay off these expenditures from the government is worse off in its totality than collecting taxes, because one thing that collecting taxes does, of course, is people get an immediate burden in their discretionary spending. People are paying the taxes now, and so they can see the cost of these government programs, as opposed to doing the quote unquote kicking the can down the road economics by the Republicans, in that you borrow the money, and so you don't feel the money leaving your bank account now, but you will once you have to either pay off the interest in the future, pay off the debt plus the interest, which is a larger expense item in the future, which is the very definition of kicking the can down the road. But not only that is, of course, the federal government in the meantime is also printing money. And so that also will lower the value of your spending power. And of course, that's something that happens slowly over time that people don't notice. So if the money's not physically leaving your bank account, the money that is in your bank account can now buy you less things. I'm all for this 40% capital gains. I think the tax on capital gains should be greater than your ordinary income tax. So to me, this whole idea that it's used to incentivize investment. There is no, incentivizing investment. What you're doing is you're letting people reap the benefits of the Fed's easy money policy. There should be a consequence. If you want to, if the Fed is, if you're having to sit on an asset that's getting appreciated by the Fed, you're going to have to pay your taxes, which is going to inadvertently show you sort of the consequence of of the Fed easy money policy. So to me, I'm all for this. I think we should get rid of this preferential treatment on capital gains. Put in, put in even a flat 40% tax rate. It's unearned income. You haven't earned. You're purely benefiting off the appreciation in the stocks, and it's mainly going to affect the super wealthy. So to me, this is going to be a big thing, and it may even halt inflation. I mean, if you think about it, this tax is essentially a tax on the inflation. If someone, because again, we're arguing that most of the appreciation is inflationary, and so if your assets are riding the inflation wave, to put it simply, if your assets are, or to put it in a per se, if your assets are riding this inflation wave, you're going to get punished because the rich benefit, the rich have it easy in an inflationary environment because they have these assets that are inflating. The middle class and the poor don't have all these capital assets, and so they're the ones who are bearing the brunt of this inflation because their income is not keeping up to the rate of inflation, and yet the cost of their, the cost of living is riding the inflation wave, and so their cost of living is going up, their income is not going up, and so net off in real terms they're worse off. So what this will do to the rich is that, yes, their capital assets are riding the inflation wave, and so they're not really being hit. However, once you implement this 40% capital gains tax, then they're going to start feeling worse off because now all that supposed inflation appreciation that they were gifted is now being taxed at 40%. So they only get to keep 60%. And that 60% isn't going to cover, of course, the entire inflation. Again, to put it simply, let's say I have an asset that went from $10 to $20. So, and all that $10 in appreciation is inflation. But now that I have to pay a 40% tax rate, 40% tax, my assets in real terms only appreciated $6. And that doesn't cover the full $10 in real inflation that occurred there. So that cost of living, I still get hit with the cost of living, in a reduction in the cost of living, just as how someone in the middle and poor class, in the lower and middle class would get hit. So to me, I'm all for this. We need to get rid of these preferential treatments and all these capital gains. The wealthy and the rich who have these capital assets and benefit from their appreciation just by the Fed printing money, are going to get penalized with this 40% tax rate, and they're going to finally realize, wait a second, I don't want inflation. I don't want to, I actually want to convert my unearned income into earned income. And with that, I think they should, the rich and the wealthy will realize, the Fed is not really doing them a favor anymore if they can only keep 60 cents on the dollar for every dollar the Fed prints. So that was it. I hope I kept it a little brief. Again, I plan on maybe doing a Facebook or maybe having some sort of platform where you guys can ask questions and there can be a back and forth, or maybe once, a month we could do a Q&A video where I answer each and one of you guys' questions. So that's it. Hope you guys enjoyed, and thanks for watching.